Hi, everyone. Thanks for joining us. I know it's kind of peak vacation time in the middle of the summer. So hopefully you guys are all taking some time off at some point this summer, enjoying it outside with friends and family. Business as usual here at Simplify. We have some exciting updates to share, some new fund launches, some new milestones with some of our strategies, and happy to be joined by Mike Green again to share a little bit of a macro update. Um, Quick little disclosure, disclaimers, of course. This is for educational purposes only. It's not to be construed as investment advice. We'll be looking to post this video on our YouTube channel after today's webinar. And then, as always, we have the Q&A function in the chat box at the bottom of your screen. Please feel free to ask questions throughout. If we see them and it's topical, we'll address them as we go throughout. Otherwise, we have Akash, who has joined us today to help field some of those questions towards the end of the presentation. So without further ado, let me share my screen. And Mike, will you let me know when you can see my screen?
I see it.
Oh, great. Beautiful photos of us both. Without further ado, we can jump right in. So really a state of the business, state of the organization as of the end of second quarter, which was June 30th, just inching in on that 14 billion in assets under management. We're recording this, of course, or sharing this update in mid to late July. So we have since passed that 14 billion in AUM. So continue to see growth of the business. We now have over 40 ETFs on our shelf. We'll talk about many of them today. 18 of those strategies have over 100 million in AUM, and three of our strategies in excess of 1 billion in AUM. Quick updates on some of our new strategy launches during the last quarter. Two which are kind of overseen by me in a multi-asset sense are both LQ and Dine. These are two of our newest solutions that we brought to market, and again, in an ETF wrapper that are going to be multi-asset in nature. So in the case of LQ, this is our liquid alternative strategy. So we're combining, like we do for many of our clients in the model portfolio business, some of our highest conviction liquid alternatives to provide a diversified solution to our investors. And then in the case of Dine, rather than focused on diversification in liquid alts, we're focused on diversification within income producing strategies. So many of our clients are piecing together our individual solutions across some of our options-based strategies, both equity options and fixed income options. And so we're just making it easier by packaging this in a single ticker solution for our clients. The added benefit, I would say, is these aren't just simply multi-asset fund of funds. We're actually looking at this through a more tax efficient lens. And so the underlying strategies themselves we're accessing via a total return swap. We definitely go to our website and get into the weeds on some of this. But the crux of this is that we're providing better tax alpha, I would say, because of the tax efficiency of some of these swaps. All of the gains are embedding within this. So rather than distributing on a monthly basis and kicking out those gains, which result in ordinary income, the goal of these is that the swap contract upon expiration, all of those gains will be distributed as long-term capital gains. So there's some caveats there, some nuances, but I would say first and foremost, providing a diversified solution in a single ticker, and then the tax efficiency is kind of icing on the cake to that. The other strategy, which you'll see here, you'll probably be a little bit confused because it says inception of 2018, is the Affinity World Leaders Equity Strategy. So this is a longer standing solution that's been in the marketplace in an ETF. And Simplify has now brought it onto its platform. And so we're supporting distribution, and it's now technically a Simplify strategy. So we're really excited about this. The kind of quick and dirty is that it's a multi-factor equity solution focused on profitability as well as a value component. And it has delivered very attractive category leading results. Actually, we should have probably had this on the Morningstar rated fund solutions as well. It's a new additive, so I guess it got missed in the last poll, but it does have high Morningstar rankings for peers. So we're excited to expand, especially knowing where Simplify's expertise lies and more of the income producing and alternative strategies. It's great that we now have a high conviction, cost-effective equity strategy that we can talk to our investors about. So, in regards to the Morningstar ratings, you'll see here, this is as of June 30th. AgH, which is our core bonds solution, we'll speak to that more later in today's conversation, as well as Pink, which is our healthcare ETF, and then our short-term Treasury future strategy, TUA, will also speak to that. All three of those funds, as of June 30th, have a 4-star Morningstar ranking. So hopefully, as we kind of wrap up this very quick overview, just to show the growth of the business is being maintained. We're continuing to diversify our solutions and continuing to really focus on the needs of our investors. So with that, I know many of you are probably dialed in today, not to hear from me, but to hear from Mike Green. He'll provide a quick overview from a macro perspective. So I'll just let you jump in, Mike, and you tell me when you'd like me to flip the page.
Well, thanks, Paisley. I really appreciate it. And I would almost emphasize what you said at the start. This is not for investment advice. This is for education or perhaps for entertainment, because anyone who is not entertained by the activities of the last quarter doesn't have a very good sense of humor. This really was actually an extraordinary quarter. I think it's really important for people to understand that the spread that occurred in this quarter between the performance of what we traditionally would think of as inflation sensitive or liquidity sensitive assets in gold and global equities had the largest spread in the history of available data, basically, in terms of this underlying performance. It was not just a US story, it was a global story. We saw all assets, although importantly, I'm highlighting here, this is the MSCI ex US. So basically, all equity assets around the globe took off. Anyone who's been following the news knows that there was a large contribution that came from places like South Korea that is now in the process of reversing on that. But simply in the United States, we actually had the phenomenal events that played through as well in that area. I'm actually in the process of writing an analysis on this in terms of the mechanical components, which I'm sure anyone tuning into now has largely checked out or gotten bored to death by my discussion of the impact of the flows into various funds and strategies. But among the other things that, of course, we saw in this quarter was the launch of an extraordinary number of semiconductor-focused ETFs. Some of those gained incredible assets, and some of those that had been around for an extended period of time, products that are 3x levered, for example, exposure to the semiconductors took on a life of their own, alongside the introduction of an extraordinary number of levered single stock ETFs. Just to orient people to this, there are 33 names in the semiconductor index. As of the start of the quarter, there were roughly 14 of them that had 3x or that had 2x levered ETFs against them. By the end of the quarter, that was 30. So we have seen an extraordinary amount of interest in the broader market in terms of ways to tap into the investor enthusiasm for this space. Some of those funds actually have grown quite large. That's had a significant impact. And while I realize how crazy this actually sounds, the analysis that I'm planning to release this weekend highlights that roughly 50% to two-thirds of that entire move can be explained by the flows into those vehicles and the endogenous liquidity that is created by levered vehicles when they rebalance. It's worth spending just a few seconds on that to help people understand what that actually means. If you think about a portfolio that rebalances on a daily basis, imagine you put $100 into that fund. On day one, it is levered up 2 to 1, therefore you have $200. If the market goes up 10%, you now have 220, of which 120 is your equity. Therefore, you have to increase your exposure to 240, which means that despite the fact that there was actually no inflow into the fund, it is net now buying $20 of that underlying. Now think about that context in the context of a $60 billion at peak semiconductor 3x levered ETF, and you have a sense for some of the chaos that we experienced in the markets on the equity side. And importantly, this is an exogenous and idiosyncratic source of volatility. There is nothing in the passive complex that says go buy semiconductors in levered form. And as a result, we actually saw something really interesting, which is that the passive bid became far less important in this quarter than the idiosyncratic demand for the semiconductor trade. It's really one of the first times I've seen that. Just to put this in context, the entire market impact in terms of dollar flow for the give or take past 3 years prior to this last quarter was roughly plus or minus $2 billion a month into the semiconductor complex. Through the ETF complex in the month of April alone, that was $45 billion. In the month of May, it was $50 billion. And we have now actually started to see that reverse, and it's become very unstable in its characteristic. It's really critical for people to understand, again, that these types of levered products are designed to express short-term trading views. And that is actually the history of what we've seen in these types of products. Crazily enough, in the past, give or take 3 months, we've seen evidence that that has changed materially, that this is being pursued by investors who are thinking about dollar cost averaging into these types of strategies. And just to articulate, that's a very novel approach to it. When you look at the volatility drag associated with many of these types of strategies running at this level of volatility, just to put a pin in it, the required return in the semiconductor index to break even at 3x levered with close to 100 vol is somewhere in the neighborhood of 150% annualized. So we are looking at an environment in which investors are either poorly informed as to the exposure of these products or they are incredibly bold. And we won't know which one it is until the game is settled. Because of that volatility drag, I actually emphasize that this is likely a temporary phenomenon. That money evaporates into the ether in a volatility drag, handed over effectively to the brokers and lenders who are facilitating those trades. And so this, unfortunately, I think is going to look a lot like what we saw in 2021, which is an evaporation of retail capital. With that said, let's go on to the next one. The underperformance of bonds has created a really interesting picture. On the right-hand side, you can actually see U.S. tips in terms of their broader exposure. I can't remember if I put in a 30 or a 10. That's a 10.
10.
There's two ways we can look at this. There is a breakout pattern underway, and a classical technical analysis would suggest that we could see much higher tips in this environment. I think that that is absurd, but my opinion matters exactly as much as how many dollars I put into the market, and even more accurately, how much money I put into the market relative to the passive fund complex. I've talked about the structure of bond indices and how they can be influenced by passive market cap allocation. It means that bonds that have fallen in price, i.e. low coupon bonds that were issued in the period from give or take 2010 to 2021, are going to be trading well below par. That means they receive less capital than they would on a dollar that you put in on a purely fundamental basis. In my view, this is actually the key story that's going on in interest rates. When people say nobody wants to buy bonds, and the answer is well, nobody wants to buy those bonds. We're actually seeing auctions go very well. We're seeing traditional measures of liquidity in the market reflect an overall healthy component. It's just an extraordinary mismatch that, candidly, the fears of inflation and everything else are notably absent from the traded markets like inflation swaps. So I return to the mechanical explanation for it. The chart on the left is a little different. This is actually highlighting a chart that was very popular in the period from give or take 2000 to 2021, where people would highlight that we had the lowest interest rates in history. It's really instructive to actually pull that exact same chart up today because oddly, nobody is circulating it. A 5% yield from the dominant economy or the largest economy in the world would be a historical extreme aberration. The only time we exceeded those thresholds were under Paul Volcker and the environment of the 1970s when inflation was running significantly higher levels than it is today. I know that there is a cabal out there that will argue that inflation is improperly reported. Unfortunately, we just see no evidence of that. Again, I reference back to TIPS. I refer to private sector entities like Trueflation or the American Everyday Price Index. None of them reflect these inflation fears. Unfortunately, I think this is increasingly becoming a combination of mechanical and sentiment, and therefore looks an awful lot like what we're experiencing within the equity markets. Let's go to the next slide. Within the quarter, one of the metrics that we continue to track is the growing divergence between credit spreads in terms of the bond markets, high yield and investment grade. And the deterioration that we're seeing coming out of the private credit space, here we're proxying it by price to book ratios for business development corporations, which are really publicly traded private credit entities, as well as we're seeing a meaningful divergence that is beginning to emerge in the lower quality high yield components. CAA and below spreads, which on the right-hand side, I've actually stripped those out of the high yield index. The CAA spreads are actually increasingly beginning to track the behavior of loans. And so it suggests that there has been a notable deterioration in terms of credit that is absolutely absent from the middle of the market, what you might call the belly of the market. At the same time, we are seeing a meaningful deterioration in credit quality amongst the hyperscalers. There we have seen CDS and credit spreads more than double for many of the securities. Oracle just recently took out its 2008 highs in terms of credit spreads and CDS contracts. New CDS contracts have been issued against most of the hyperscalers. And again, this is an area where we are seeing evidence that the market is actually very improperly positioned, but improperly positioned simply means that I got it wrong this quarter. So we'll leave it at that. When we look at the underlying fundamentals, if we look at the level of credit spreads, you can see the contraction here that's occurred in red. As a reminder, this is my credit spread model. It's built on macroeconomic factors. It historically has done a very good job of tracking credit spreads. And unfortunately, it suggests that much of the improvement that we had seen in the economy coming out of the 22 slowdown, I meant to say recession there because it was undeclared in my analysis. But when we have the flattening out that we're experiencing, the recovery in the manufacturing sector, et cetera, has begun to slow. We're seeing inventory builds and inventory pressure. At the same time, the impact of higher gasoline prices is pushing more and more consumers into utilization of credit card debt, and that credit card debt, student loan debt, personal debt, housing, mortgage debt, et cetera, is showing notable deterioration, as well as on this chart, you actually see that realized bankruptcies in the corporate sector is running at an extraordinarily elevated level relative to history. And nobody in the credit market seems to care. They're probably distracted by that spread between gold and equities and wondering what went wrong on their surefire bet in gold. And so I think if we think about the implications for this, it just unfortunately seems like we've got more of the same. And if we go into the employment market, today we got the lowest claims in recent history. Part of what is actually happening here is that there has been no inflation adjustment for unemployment insurance since 2013. So all those complaints about inflation that people are highlighting, and that is an appropriate complaint against the price level. Imagine that you are thinking about filing for unemployment and you're looking at those real benefits associated with unemployment having absolutely collapsed. At that point, driving for Uber seems awfully attractive, and I continue to believe that at the core of what we are ultimately seeing here is very flawed data that fails to capture the impact of the availability of the gig economy as a form of alternate unemployment insurance. That means that stimulus and recognition of these events are much further away than they might otherwise be. We can debate whether the change in the Federal Reserve leadership is going to lead to actions in one direction or another. But the one thing we know for sure is if they are operating off of a flawed data set, and Kevin Warsh has very clearly stated that as a priority for him is to improve the quality of that data set, it's just not going to matter. We are driving through a cracked rearview mirror in terms of policy, and I think people looking for it to bail them out in one form or another, particularly in the corporate finance sector, are running out of available oxygen in a dangerous situation. Full-time jobs in the U.S. economy peaked all the way back in November of 22 when we adjust for the population adjustments. Those population adjustments, of course, work in the opposite direction as we're beginning to see emigration. My expectation is that we will ultimately see population revisions in the opposite direction versus what we saw in 2025. That would theoretically lead to an increase in labor market tightness, but perversely, the polling, the sentiment data in traditionally correlated areas like jobs hard to find, job versus jobs easy to find, suggests that the actual misstatement at this point is largely on the unemployment. So an emphasis on what Kevin Warsh is focused on in his transition. The quality of the data remains very suspect, and I would argue that we continue to see a broader slowing in the economy that suggests that those interest rates are simply too high. And I think that's as reasonable. So the one real benefit from my personal standpoint, of course, is that Elon Musk took advantage of the rule changes associated with the NASDAQ 100 that facilitated one of the first mega IPOs that we have seen in living memory. The IPO of SpaceX, a lot of people will look at the trading of it after the issuance and point out that it is now traded below issue. First, that's fairly common activity for an IPO. I want to emphasize that. But more importantly is remembering that what we actually saw was a quintupling of the valuation of SpaceX and largely on the promise of its non-cash flow generating, in fact, hemorrhaging cash flow components in terms of XAI. I continue to argue that the primary reason why we have seen these IPOs is the change in rules associated with the passive indices that allow those who want to participate to increase their confidence. It is very unusual to hear it announced that an IPO is going to be X representation within an index before it's even had a roadshow. In this case, those roadshows were again targeted retail investors. The vast majority of the trading that we saw in advance was effectively index arbitrage. And if we think about the inclusion of Tesla into the S&P 500, we saw almost the exact same behavior in the private market valuation of SpaceX. This is definitely going to be one for the record books. But the most interesting thing from my perspective is suddenly everyone is talking about the impact of passive. After 10 years of listening to people say you're crazy and there's no impact, suddenly I appear to be on speed dial as everybody is saying, tell us about the impact of passive and how it facilitated Elon Musk becoming a trillionaire. These feel like bedtime stories occasionally with Mike, but again, what an incredible quarter, what an unbelievable event. And for those that are worried about Elon Musk, just remember he now has liquidity. We'll leave it there.
Thanks, Mike. So I would say to recap, I mean, one of the biggest risks or opportunities, depending on how you view it, is just perhaps most being offsides and kind of the view of rates, which I think maybe then leads us to a good place to start from like a fund perspective. And we mentioned this in last quarter, and I think it maintains its relevancy. Simplify's goal, of course, in providing innovative strategies for our clients is that we essentially provide a menu for you guys to make decisions based on your market views. Mike shared some of his views. We have a lot of different house views across whether it be rates or equity valuations or the role of alternatives. And this, I think, is a great example of our duration suite where we've been able to deliver something to clients to let them choose. And so I just wanted to reiterate this suite. I would say, as it relates to second quarter, it was a bit of a challenging environment for many of these products. We had a lot of whipsaw from the level of rates, direction that rates went as a result of some of the CPI releases, Warsh stepping in. Obviously, oil prices had a big impact on that as well. And many of these strategies, especially RFIX and PFIX, which are doing longer dated swaptions, that are more appropriately utilized for kind of short-term tactical views. And so because we had this range-bound movement of rates throughout the second quarter, there was a bit of a headwind for some of these strategies. So despite the fact that rates did move higher across the quarter, PFIX, which has a negative duration performance, was maybe not as strong as you would simplistically have calculated just based on rates going up, negative duration should mean positive performance. So those the strategies really benefit from kind of rate volatility over short periods of time. They still maintain their relevancy, though, as it relates to if you have strong views on the direction of rates, if you think, as Mike just outlined, that markets are severely pricing that, mispricing the ability of rate or yields to fall. Having something like RFIX in the portfolio can be a way to express that. I would say from more of less of a tactical, more of a strategic view, TUA and TYA are attractive interest rate or duration tools that our investors have utilized. Whether your preference is on the front end of the curve, I think there's a lot of expectations now with just the repricing, with war stepping in and inflation starting to cool from the latest print. Although rate hikes are still on the table, as we know, that could be repriced quite quickly. A strategy like TUA, which is going to be 5 times the 2 year, could benefit meaningfully. And then TYA is going to be more of your longer duration play, where it's going to be 3 times the 10 year. So again, these are just tools for our investors to access based on their own rate views. And I would say the capital efficiency of these and the access to institutional grade derivatives in the case of PFIX and RFIX, swaptions within those strategies, really institutional grade rate tools. With that being said, although second quarter, I would say, did see headwinds for those rate tools that I just described, it was a really nice backdrop for Ag H and Buck, which I want to talk about as well. I think there's been this reluctance to just pile into traditional core fixed income strategies because the yields aren't that attractive, as Mike even outlined. Although his model might be pricing credit spreads to be a bit wider than we are today, the market is pricing them still quite aggressively. So you're not getting much pickup in your kind of core bond solutions like the ag. And so how can you enhance your yield potential? And Buck and Ag H, through their options writing programs, have the ability to enhance the distribution rate over traditional cash or core bonds. And so an environment like the second quarter, where we did see some rate volatility, but it was range bound, is the prime backdrop for these strategies, where we can really just continue to harvest that yield, pick up that additional premium without adding incremental volatility over some of the more traditional strategies. I think it's also helpful to point out in the case of Ag H, really in the year-to-date period, we've seen volatility come down meaningfully. And that's more of a, I would say, intentional view on where rates are. And again, our ability to harvest this yield premia through options writing program without taking additional vol. So Shailesh Gupta, who's the lead PM on that strategy, again, intentionally said, not the environment to be, reaching for yield, but we're still, as you can see here, as of the end of the second quarter, distribution rate on Ag H is a little over 7%. So that's a pickup over the core bonds, which are having a distribution rate closer to, say, 4%. So picking up meaningful yield and doing so without taking on incremental volatility. And so I think this becomes a really attractive way, and how our investors and clients are using this as a diversifier, right? So you still have that interest rate risk, but you're now getting compensated for taking on some of that risk through the additional distribution rate on that. I would also highlight that as Ag H's track record has produced really attractive returns as well as growth in AUM, we have started to see some momentum in this strategy. So we recently passed 500 million in AUM, and we are nearing 600 million. So I think investors are really starting to understand the role of this in a portfolio, as yields are just really, again, not making the cut for a lot of advisors' needs to meet their client objectives. So maybe sticking on that topic of income for client needs, KNRG is one of our newer strategies. We launched it in May of 2025, so we just passed our 1 year track record. This is in partnership with Kayne Anderson, one of the leading institutional players in more of like the real asset business. And I think this is super exciting. We talk a lot about AI and the impact that that's having on the economy as well as markets, often through an equity lens. And so the ability to access some of these themes and some of this momentum as it relates to the data center build outs, the need for greater use of power to support a lot of this. KNRG, which is again the Kayne Energy and Infrastructure Credit Fund, is a way to introduce this kind of thematic type solution within your fixed income sleeve. The additional benefit is the yield is quite attractive, kind of on par with the distribution rates that you're getting from high yield credit. But historically, this subset of the market and the strategy that Kane Anderson is managing for us has higher quality credits. So similar yield, higher quality credit. And you can kind of view this as the picks and shovels part of this theme rather than, back in the gold rush, rather than buying gold itself. Those that invested in selling the picks and the shovels became much more successful. And so this is really looking at the build out, as I mentioned, from a grid perspective, the infrastructure for these data centers, the power to kind of facilitate these businesses. I would also say too, oftentimes when our investors broadly see the word energy, they're going to directly tie that to the price or volatility of commodity markets, oil markets, et cetera. And the beauty of this is because it's within the infrastructure space, a lot of these contracts are very long-term in nature and not tethered to the price of commodities directly. So you're really accessing kind of on the ground exposure to one of the biggest, I would say, themes of the current generation and really the need for like the reshoring or the onshoring of a lot of the manufacturing as well. So this is a really attractive opportunity, nice complement to your existing high yield credit. And again, going back to Mike's views on where credit spreads are today, this is going to be a differentiated exposure within that cohort that's providing higher quality access.
And that is just as a quick aside, the energy sector is one of the components in which we have seen obviously fundamentals improve quite significantly. Prior to COVID, we had an extraordinary correction in the oil and gas and energy space that was tied to the overbuilding associated with the shale components. That means underwriting tends to be higher quality in a lot of these types of assets than we would have otherwise seen with investors having been burned in recent memory. And the team over there is just really fantastic. I'm a huge fan.
Yeah. So if any of you are interested in learning more, Chris Getter, one of our strategists, knows this story and the strategy very well, and can also connect any of you directly with the Keen Anderson team. As Mike said, they're really impressive. They know this market really well, and they have the added benefit too because of the breadth of their business that they're also underwriting some of the equity. Of the same companies. And so they have kind of that 360-degree view to kind of see from a full kind of cap structure um, the strength of a lot of these companies. So maybe let's pan out a little bit, still staying on the topic of income, but moving to kind of a different risk premium. So if you think about Ag H and Buck being more closely aligned with kind of core bonds, K-Energy being more of a diversified solution within high yield, and then now really thinking about from a yield perspective, moving further out on from a distribution rate perspective, excuse me. So SBAR is our barrier income solution. We've seen significant growth in this strategy since it launched in second quarter of 2025. This is also referred to as auto callables, which we've seen kind of a boom of these strategies come to market over the last year. Simplify was first to market, which I think we're just kind of leading from an innovation perspective. And the way that we think about this is you're really taking on equity income risk. So the distribution rate on SBAR will fluctuate over time, targeting anywhere from, say, 10 to 12% annualized distribution rate, which is generated through writing options on a Worsted basket of Russell 2000, NASDAQ, and the S&P. And so there is, I would say, a correlation to overall equity risk. The beauty of this, of course, is that it's diversified from some of your traditional income. And this goes back to my comment around investors broadly, many of which have thrown in the towel on interest rate risk and duration risk, but are still looking for ways to produce attractive income in their portfolio. So again, the high level of yield that this can deliver, or distribution rate, excuse me, and then the key benefit of also having downside risk, or excuse me, downside protection. And so you'll see here, SBAR has a set barrier of down 30%. So we're writing, again, writing barrier options on the worst of basket. In aggregate, we have anywhere from, say, 45 to 50 of these contracts. So a lot of diversification within the fund itself at any point in time. as equity markets rise, essentially these are being called. We're getting to keep that premium despite not holding it for the full period. So there's a benefit too in an environment, say like second quarter, where equity markets are rising. A lot of these options that we've written are getting called. And so that premium that we're able to capture. And then again, thinking about on the downside scenario, when we do see a drawdown in markets, these barrier options are written so that you have protection down to 30%. So I'll pause there. Anything, Mike, that you would want to add on SBAR?
No, I mean, I think the critical component here is that we continue to see growing demand for higher levels of income, accepting that there are components of higher risk associated with it. People don't want to sell their equity exposure. They have become accustomed to much higher yields on this. These provide mechanisms to gain exposure to it. And in many ways, it is a form really of high yield credit. It's just a diversified portfolio that is ultimately struck against far more downside in equity markets than we've seen in a long time. And so I think it's important for people to recognize that these are tools that can be used in portfolios as a component of income that can really improve the cash flow characteristics of portfolios in a relatively tax efficient manner versus selling highly appreciated underlying securities. It does address some of the components that we have constantly run into, which is the demographic shift away from equities into fixed income as the boomers age. We're seeing more and more evidence that they are engaging in strategies like this that have equity-like characteristics, allowing them to preserve the optionality of participating in equity markets while simultaneously generating the income.
And I would say too, just as perspective, thinking about allocations to this type of strategy, it is a core component of many of the model or multi-asset portfolios that Simplify manages. So again, ways to diversify away from, say, interest rate risk, or even direct credit spread risk. It's just a different flavor of risk premia. But again, if you're looking at core bonds around 4%, SBAR provides a distribution rate again that is in the low double digits. And so that can be a really meaningful enhancement. And you can think about that from maybe not even having to allocate as much as you would to core bonds. But there, of course, is no free lunch. It's just a different type of risk premia. But with the proliferation of these types of solutions now available in ETFs, this becomes very attractive for a lot of advisors building income solutions for their clients. And then I might also just give a pitch. Jeff Schwarty is the strategist covering SBAR. If you guys have any questions, want to reach out to Jeff directly. And we also are posting, I think, weekly updates that kind of show all of the options, kind of where they sit from a callability perspective, where they sit from the drawdown perspective, so you get a real-time view of all the underlying contracts that make up the total basket. I decided to mention HEQT, which is our hedged equity strategy. It's hard in an environment where equities just continue to move higher and higher and higher. The resiliency that we've seen from the market cap weighted kind of equity markets broadly, it's hard to think about, this being an attractive opportunity to hedge your portfolios. I would argue this is a perfect time, right? If we're sitting on a lot of embedded gains, we have concerns, whether it be in just the recent shift we've seen from like the hyperscalers to the semis, now looking at more of like free cash flow dwindling and even moving negative in some of these mega caps. I think the joke on the street for a while was the Mag 7 is now known as the Lag 7. There's just a lot of uncertainty in markets broadly, especially with geopolitical tensions, which we thought we were kind of through the woods on, that have started to rise back up in the last week or two. And so when you sit in your seat as an asset allocator and you think about ways to hedge your portfolio while still remaining in the market, hedged equity solutions become very attractive. Typically, we'll look at this relative to, say, a 60-40 as the benchmark. So you can even source some of this from equity and from fixed income, which our clients, again, that are kind of anti-interest rate risk at this part of the cycle, that's an easier trade for them to stomach. But really looking at this kind of costless collar type structure within the market, buying a 3-month 5% out of the money put option. So that's kind of your participation is from 0% down to 5%. So that first kind of 5% leg down you would participate in. And then you're protected from down 5 to down 20. So we're selling a 3-month 20% out of the money put option. And so again, that's creating kind of your downside corridor. So anything below 20%, you'd start to participate again. And so then you think about how do you fund some of that put option that you bought as well. And you're doing so on the other side, which is step three, you'll see here by selling a 3 month out of the money call. The actual level or barrier on that will vary just based on market. But this isn't an environment or this type of solution or strategy where your upside is capped on a quarterly basis. So if we continue to have these, 15, 20, 25% return of the equity markets, there's potential to leave a little bit on the table. But I would say, again, on the other side of that is if we do have a meaningful drawdown in markets, this is going to be a strong contributor to the portfolio, just given the payoff profile that you see here. So again, it's difficult when the markets are full steam ahead, but it's also, I would say, probably a very opportune time to think about ways to, again, stay invested without moving to the sidelines or moving to cash, but maybe take some of the chips off the table for your clients.
Just one quick observation on that. I mean, when we think about that type of product, a hedged equity exposure that is doing the costless collar component, it is really an equity-like exposure with a reduced beta component to it because you are sacrificing part of that upside in exchange for more protection to the downside. Again, it's simply a way of turning a position into a slightly less risky overall exposure. The really critical thing that I continue to emphasize on HECT is that it's really all about product design. We were not first to market on this. We were the first to recognize that the liquidity of the option contracts that are being traded and the basis risk versus the underlying really matter significantly. And it has led to extraordinary outperformance of AGQT versus competing strategies in the exact same space. It's one of my favorite funds in terms of just its technical composition.
And I would say another big differentiator, which you just mentioned, was kind of like we're laddering these callers. So there's diversification in that versus rebalancing luck, as we like to refer to. But the other difference is that for the beta exposure underneath, we're not doing active security selection. We're just picking up the underlying beta through IVV or an SPY type strategy. So there is that element as well in an environment where active management with at least within equity selection has continued to be challenged. Some of that outperformance has come from that as well. I know Mike doesn't like passive, but it's worked
I,
in his
I have no objection to passive. It didn't do anything to me.
favor. Not yet.
Not yet.
So let's pivot a little bit. We went through some of the income strategies. We talked about starting to think about ways to diversify your equity risk. And so taking one step kind of further out on that plank and really thinking about true low correlation strategies, really interesting, innovative solutions to think about diversification. And Foxy, which is our long short currency strategy, continues, I would say, to rise to the surface for several reasons. You'll see here attractive absolute return in which it's delivered since its inception of February 2025, outperforming its benchmark as well as the S&P 500. So just to be clear, its official benchmark is the Bloomberg FX or foreign exchange carry index. But typically, just given the vol profile of targeting around 15% vol, and oftentimes clients funding this from equities, it's just a helpful reference point to show versus equity risk in the portfolio, but also because a core objective of diversifiers is to offset or balance, mitigate some of that key risk in the portfolio, which is equity risk. And so it's a little bit small, so I'll describe it, but the white line is Foxy. This goes back to the inception of the strategy through the end of second quarter of this year. The yellow line is the S&P 500. So you'll see like we launched this kind of leading into the tariff tantrum last year. And so you'll see the strong performance the fund was able to capture leading into that, a little bit of vol, which was experienced as expected. But I think what's more important is the behavior, the relationship between the white and the yellow line. So white line again being Foxy, yellow line being the S&P 500. And when you think about a strong diversifier, you think about those offsetting return profiles. And so Foxy, especially even in earlier, towards the end of first quarter this year, when we started to see some of the geopolitical tensions rise and the S&P started to sell off, Foxy did a wonderful job, I would say, of offsetting that and providing ballast within portfolios. And then even more recently with some of the kind of sideways choppiness that we've seen in the US large cap market, Foxy's continued to kind of full steam ahead. So again, the absolute return profile is very attractive. The diversification power is very attractive. You'll see here about a 0.34 correlation to the S&P 500 index since inception and about a 0.18 correlation to core bonds. So diversifying against both stocks and bonds in the portfolio. And then the last, I would consider very attractive components of Foxy is that because this is a long short currency carry strategy, the yield delivered from the carry profile, the interest rate differentials in many of these countries is what allows us to distribute just shy of about a 9% distribution rate. So if you think about it from a broader objective, you're getting attractive distribution rate, much higher, more than double that of core bonds, attractive total return, all the while diversification against those key parts of a traditional portfolio. I might say too, as it relates to second quarter performance in particular, despite all these really attractive numbers that I've just shared, and you can kind of see this in the chart here from a visual perspective, it was kind of a sideways choppy market. The beauty of Foxy is that we have long short in both developed markets as well as emerging markets. Neither of these are taking a direct view for or against the US dollar, which I think is another very attractive component piece of this. Many of the currency strategies on the market are biased for or against the dollar. This is US dollar neutral, and that basket between developed and emerging market will scale based on the volatility. So it's an inverse volatility measure. So as emerging market currencies become more volatile, their component within Foxy will be reduced and vice versa. And so through kind of the second quarter, it was kind of quiet. There just wasn't a lot of opportunity or attractive areas really to take risk. And so I think that's also really important because when you do see the return profile of Foxy take off, there's just a really attractive opportunity to harvest yield and to go long or short various currencies, but it doesn't mean that we're always shooting for the moon in this strategy. It is fully systematic. It was developed by Ken Miller, and this has been one of our strongest returning strategies, as well as really attractive growth in the fund. We got a very large allocation earlier this year, which has just helped boost AUM. So this is one of my favorite strategies, and so please reach out if you guys would like more information. All right, CTA, near and dear to my discussion. So we won't sugarcoat it. CTA had a very challenging quarter. You can see that in the white line here on the graph. The orange line is our 60/40 reference. Of course, the official benchmark of CTA is the SocGen CTA index. But at the end of the day, that's not a very relevant conversation for most of you with your clients. You ultimately want to see how does this stack up versus a traditional portfolio, in which case I'm allocating to CTA to get that diversification. Typically, and I show this chart every month when we do the What's Trending in CTA videos, it's one of my favorites. I always say it's like less important about which of these lines is on top, and it's more so the co-movement of them together. You're allocating for diversification, which CTA continues to deliver. As you can see here, performance was really directly tethered to the price of oil during the second quarter. So although we had really strong performance kind of early in the quarter, as we kind of peaked from an oil price perspective in about mid-May, it was about May 18th, 19th, the long position to Brent crude, ultimately the initial tailwind became a very strong headwind in the back half of the quarter. And so that's what you see this drawdown here. You can see in the past we've had additional drawdowns, maybe not to this extent. Silicon Valley banking crisis back in 2023 was probably the more extreme drawdown until this more recent one. So please do check out our monthly videos on what's trending in CTA. I think it's helpful just to understand kind of the catalyst and some of the drivers. But as we always say, again, the key objective is to provide diversification. But we are cognizant, of course, that return is also allows you guys to keep this in your portfolio and when your clients are looking at some of the line item risk. So just wanted to highlight that. I would say from a model perspective, you might also see that some of the strategies holdings or the positioning has become a bit more concentrated. That is intentional by design. Overarching, I would say some of the recent tweaks to CTA align with the desire to be kind of less vol constrained, meaning that in the past, the strategy itself has penalized certain positions for being more volatile. And so we've removed that barrier to allow the strategy to be more opportunistic, to chase some of these strong price trends. And as a result of that, there will be higher volatility experienced as well, which you can see here. This is only, of course, through the end of June. We've had some strong performance over the last couple weeks as oil prices have started to pick back up. But we are here to answer any questions, here to jump on any calls. And like I said, the monthly What's Trending and CTA videos are also helpful to get a better idea of current positioning and performance beyond what you can see on the website. So I want to be cognizant of time. Anything else, Mike, that I've missed that we want to talk about?
No, I mean, I think you hit on the critical components. We saw spectacular performance out of some of our funds, and some of our funds really struggled. And I think in general, this has been a really challenging environment in which we've seen a combination of a grip of nihilism, conspiracy theories about treasury trading oil futures, et cetera. Most of those are really evidence, in my opinion, of just general investor confusion. Reminder that markets are always a place for convictions, strongly believed but loosely held. And we need to make sure that we examine the evidence as much as we possibly can to make sure that we are diagnosing it correctly. I continue to emphasize the growing role of mechanical rebalancing and mechanical flows in markets. And as I've talked about recently, I look forward to sharing some of those thoughts in the future.
Awesome. I don't see any questions. Akash, did I miss anything?
I think Mike, thanks for answering
Yeah, I've been
most of
hitting
them in
some
the
in the
chat.
background.
Yeah. Just to get one out, I guess, so everyone can hear one. Mike, for you, is it the same investor capital driving chip stocks that is driving the indexes? Qualified assets can't chase chip stocks, can they? You have any
By
thoughts on
qualified,
that?
they were referring to retirement assets and pension plans in one form or another. There are actually very few limitations. What we see primarily in things like 401k plans or IRA plans is not so much the inability to target these as much as it is the generic setting in which they are allocated. So somewhere in the neighborhood of 95 cents of every retirement dollar in the United States flowing through a 401k program is going into passive indices, and those would not be the areas that we're seeing at Chase. But that ignores a very large pool of discretionary capital that sits within both the RIA and the high net worth and ultra high net worth communities, as well as a bunch of young speculative individuals like Akash. Um,
Like me.
the impact of those flows are significant. But again, just to put this in perspective, when you think about the aggregate quantity of capital that has flowed into that space, we need to consider how much of it is coming through in a levered form, how much of it is coming through in an unlevered form. And if it is coming in with the leverage components, and we are very much seeing the industry trying to facilitate that offering, as Eric Balkunas always refers to it, the hot sauce to investors, passive vanilla, we're going to see this continue to grow. The barriers to entry remain very low. The attractiveness of investor capital remains exceptionally high, and everybody is looking for lightning to strike in one form or another. I'm not a huge fan of the business model in terms of pursuing that, but I understand why it occurs. And again, until we see meaningful evidence that this is reversing in some significant fashion, I think it's very hard to argue that this is a temporary phenomenon. One anecdote I'm increasingly sharing with clients is if you have not looked at Trump accounts closely, I would encourage you to do so. You have basically two investment options, the S&P 500 and the total market index. So we have to be really thoughtful about that. We need to understand that there's nothing on the horizon that seems to be changing anytime soon. But investors have begun to modify behavior. We are seeing more interest in, trying to derive a causative feature here. If it's all about AI or it's all about semiconductors or it's all about gold, as we saw last quarter. It really is a question that investors seem to be asking themselves, and the answers are increasingly idiosyncratic.
Cool. Thanks, Mike. I guess one more kind of more of a macro question. Do you have any thoughts on So why do you think Japan is waiting so patiently to intervene in the currency market? I guess broad
I think
question.
the biggest concern amongst the Japanese policymakers is at this point is what are the implications if they choose to? So they have, raised interest rates significantly, just like in the United States, with a high level of debt to GDP that proves to be a form of fiscal stimulus. This was an expression in the macro community 20 years ago. If Japan actually wanted inflation, they would raise interest rates. And now, of course, they are attempting to fight inflation by raising interest rates with predictably terrible results. Um, I allude to it when I talk about the dashboard and the information that we're receiving. This is a time period that we will ultimately write about in the history books. And my hunch is that we will look back on the choices that were made by policymakers and say, as John Maynard Keynes pointed out nearly 100 years ago, practical men who fancy themselves exempt are slaves to the defunct economist. And that continues to be my general view on the process of policy making, both in the United States and in Japan.
Cool. Thanks. I'm gonna have to write that quote down and think it out.
Yeah,
But,
that would be a good tattoo, maybe.
There you go.
oh, right,
Who
right,
says I
right.
don't already have it? Yeah.
On
All right,
that
guys.
note, yeah,
Thank you very much.
I want to close out by thanking Mike as always for his insights. But more importantly, I want to thank all of those who dialed in, all of our investors, our partners. We couldn't do this out without you guys. We are here to answer any of your questions. Please reach out afterwards. I mentioned some of the key portfolio managers and strategists at the firm here that have developed these strategies and are managing them. So we have a breadth of individuals and resources that can answer your questions, get into the weeds on any of these strategies. So thank you again. Enjoy the rest of your summer. And Akash, thanks for helping us run this today.
Thanks, Paisley. Thanks, Mike. See you, everyone.
Take care, guys.
Yep.
Bye. Thanks.